Today I wanted to spend some time to go through with you the trends we're seeing around sustainability, both globally and more locally. I then wanted to focus on green bonds as a financing tool and discuss how these could be applied to low carbon buildings in Australia and New Zealand. And then finally, some time outlining where we see the green bond market heading in Australia and New Zealand. And if this interests you, go through some of the actions you can be taking in terms of leveraging this growth opportunity. So to start with some context on sustainability, and I really think it's clear from the interest here today and the words we're hearing globally, the transition is on. We have Paris Agreement signed 2 years ago and ratified by over 190 countries, including Australia and New Zealand, stating that countries will limit global warming to well below 2 degrees and that we will aim for a net zero emissions world between 2050 and 2100. This transition will require trillions of dollars spent by both the public and the private sector, so it's important to think about how we'll finance that as well. One of the next key trends we're seeing in the global market is in relation to the Financial Stability Board's task force on climate-related financial disclosures. Now, this was established by Mark Carney from the Bank of England and it's chaired by Michael Bloomberg. And the task force seeks to develop recommendations for climate-related disclosures that are consistent, comparable and clear. This kind of transparency will allow investors to more clearly choose between one investment opportunity and another and make better informed decisions on how they'll allocate their funding. This is really important because these investors, there's something like $45 trillion of assets under management for investors that have said they will make sustainable investment choices and choices that relate to climate change. And then the third key trend is around the Sustainable Development Goals that Andrew mentioned. The Sustainable Development Goals have been put together by the United Nations, and these are 17 goals, came into force early 2016, and they're a framework for both developed and developing countries to work towards ending all forms of poverty, to fight inequalities, and to tackle climate change. So certainly no small feat. And these are the three main global lenses we see that are shaping real companies' investment choices and investment decisions, and something we see as a guiding principle. But closer to home, in Australia, APRA announced recently that climate risks pose a real financial risk, and they reminded us that board directors will be liable where they haven't taken climate risks into account in their investment decisions. Now, this is our Prudential Authority. The New Zealand Stock Exchange is refining its listing rules, so listed entities will now have to report on their environmental and social risks as well as financial risks. So you can see this is not just a sort of a faraway thing, this is happening close to home as well. And these global and national trends lead us to believe that both investors and businesses will be paying increasing attention to sustainability and climate change, and they'll be examining how their business needs to adapt in order to transition to a lower carbon economy. From ANZ's perspective, we see that a huge amount of change needs to happen, and so the team that I'm in, Sustainable Finance, was established a few years ago to help our customers who need financing for this transition. ANZ has a $15 billion pledge towards financing low carbon and sustainable solutions out to 2020, and we've already financed and facilitated $7 billion of that in the first 2 years. I think this is key to where business is heading. And it brings me to green bonds. Green bonds have the role, at the moment have one of the major roles of helping to fund this environmental change and as the mechanism for helping fight climate change. But what are they? Essentially, green bonds are really similar to vanilla bonds in terms of taking the issuer's risk profile and their price. The key difference is that investors receive an additional amount of information in relation to the use of proceeds. And that is, proceeds need to be notionally earmarked to finance or refinance environmentally friendly projects, assets, or business activities. I'd like to draw your attention here to the word refinance. Bonds are generally a refinancing tool. They're not commonly used for the construction of new things, and in the green bond market, that's also the case. So if you already have a green building built, you could use a green bond to refinance that building. And investors and market commentators globally are absolutely on board with this strategy, all in the name of developing a deep and liquid green bond market, in the hope that over time this might help to drive down the cost of capital for environmentally friendly projects. In terms of where has this market come from, it's been in existence since about 2008, although you can see from my chart there, it really only started kicking off in 2012, and since then really exponential growth up. This year, we've had over $100 billion in green bond issuance year to date. We are still holding out for this 130 forecast, although time is running out very quickly. And you might think that with such exponential growth over a short period of time, perhaps this market has had its day. But there's a lot of research gone into something the market likes to call the climate-aligned universe. And currently, this 100 billion is only a small fraction if you consider it's like the tip of the iceberg. There's considered a $900 billion climate-aligned universe waiting to be green bonded. So there is a huge potential for this market. So then it comes to, well, why would you issue? I think it seems pretty clear from an investor's perspective, why would you buy these issuances? If you have a mandate to buy and you've made public statements around, I will invest in sustainable transactions, then from an investor's perspective, very clear. But why would an issuer issue a green bond? Isn't there time involved and money? And I think, to me, the key benefit for an issuer is this idea that you can access additional pools of investor liquidity that you would not have otherwise been able to access. The pie chart you can see there on the graph is for a transaction we did earlier this year for Investor Commercial Property Fund, which was in relation to low carbon buildings. The dark green at sort of 30% of investors, these are the ones that have got explicit green funds or explicit mandates to invest in sustainable solutions. The light green at around 40%, these are investors that bought this issuance primarily based on credit risk and profile and price, but they're quite happy to get the additional benefit around the green use of proceeds, and they're quite happy to add a green tinge to their portfolio. And then the grey investors there at around 30% again, these are your normal investors. They were going to invest regardless. They don't mind about the green thing, but it doesn't matter to them either way. They're in there because of price and credit profile. And I think this type of graph shows you that as an issuer of green bonds, you do get your normal investors, which I would call the grey and the light green. These are all the ones you would have always got. But then the dark green investors, this is additional. So this deepens your pool of investor liquidity, adds to tension during the pricing and size phase. So I think this has got to be one of the key things that issuers look to include when they're thinking about how to raise money. So then maybe a little bit of time spent on, well, how do they actually work? How can you say that your bond is green? There are three main mechanisms in the market globally. The first is around self-labelling. So my company, I can say, this bond is green, trust me, you can buy my bonds, and that does work. We would recommend, it does for pure play companies, I think it could be quite successful. But ANZ would probably recommend that you go down one of the other two routes around the Green Bond Principles or the Climate Bonds Initiative, or the CBI. So the Green Bond Principles is, as it suggests, a principle-based approach. You can see their high-level asset classes that they say qualify for green projects. And for example, renewable energy is just stated renewable energy. And then it's up to the issuer to determine what renewable energy projects and at what threshold are considered green enough for their bond. So that's a judgment and a principle-based approach. The alternative approach is under the Climate Bonds Initiative, which has, you can see the taxonomy up there on the right. It's a lot more detailed. So whilst it has all the same asset classes as the Green Bond Principles, underneath, say, energy, there are specific criteria set out for solar, wind, geothermal, etc. And within each of those criteria is a 10-page document that has been negotiated and discussed by a technical working group for over 12 months as they come to a decision what does count as green, and keeping in mind the Paris objectives to 2050, and that's what their guiding principles to determine what really qualifies as green in this market. Under both of these approaches, you would need to get a second-party opinion, or we would recommend getting a second-party opinion from, say, Big Four firm. EY is very, very popular in the market, or from one of the more sustainability-focused teams, such as Sustainalytics or DNV. There is one other major piece of work that needs to go into producing this. I say major, it's in the context of green bonds. It's not a huge amount of work. It's a sort of 4 to 5 page document that outlines your framework and how will you use your proceeds. And it usually would follow 4 main pillars around use of proceeds, so that's your selection of assets, the process for evaluation and selection, so that's how did you determine what qualified as green and how did you decide which assets you'd put into your bond. Management of proceeds, so how do you manage this bond over time? How do you show investors how your funds are being used and appropriated? And then how often will you report on them? Will you report semi-annual or annual? Often this is rolled into your normal financial reporting cycles. So that's how you make a bond green. But I thought maybe it might bring it to light a little more if we focused on low carbon building specifically and how to make a low carbon building green bond. Again, under the 2 approaches, the green bond principles is a principle-based approach. You would use guidelines. So where buildings meet a certain criteria, for example, neighbours NZ, you would set what your criteria, what you think the threshold should be based on the cities that you're in, and then determine what your buildings ratings are, and then those qualify as green assets. Under the Climate Bonds Initiative, they do have specific criteria in place for residential buildings, commercial buildings and upgrades, and they have got established baselines in various cities around the world. The restriction here is that this doesn't cover all your buildings, so if you had an industrial building you wanted to put in, you couldn't qualify under the CBR, you would need to go down the green bond principles route. Likewise, you can see that at the moment they do not yet have baselines set for New Zealand. They are bringing those out shortly. I think it might be a sort of a relationship around data availability in New Zealand, but should come out shortly. I think this is only going to be for Auckland. So again, if you have buildings in other locations, then the CBI probably won't work for you. But the CBI's is the Climate Bonds Initiative form is a very scientific approach. They say that in order for a building to qualify, it needs to be in the top 15% in terms of emissions intensity for that city, and that ratchets down to 0 over to 2050. So if your bond is longer, then you have harsher criteria to meet, and they take into account all this kind of technical side on your green bonds. They also do have, I mentioned, upgrade criteria. So if your upgrade results in a carbon reduction of 30%, then that qualifies as a green building for the purposes of your green bond. So we've spoken about the direction of the global market, but I thought it might be useful to go into a little more detail around where we're seeing the Australian and the New Zealand market going over the next few years, and maybe starting from where we've come from. So in Australia, perhaps draw your attention to the chart down the bottom. We issued our first green bond in April 2014, and since then the market has really taken off. So there have been 19 issuances with a total value of approximately $6 billion, and you can see that it does happen quite quickly. The chart at the top shows where Australia is in relation to the rest of the world. Currently New Zealand doesn't feature, but you never know, it could be very soon. I actually think it's quite interesting to see the really big role that the United States and China are playing here in the green bond market, because China actually only entered the green bond market last year. So in just 2 years, it's moved from 0 to, well, very close to the top. So it's a very interesting, I think watching what China does is always a very, very interesting way to see where you think the world is headed. Now in New Zealand, the very first green bond was issued only a few months ago by IFC. This was a transaction that ANZ worked on, and it was a green Cowrie bond. And this green bond transaction was very quickly followed up by someone more close to home with Contact Energy, who you may have heard. They issued not just a green bond, but actually they got a green borrowing program where their entire portfolio of debt was certified by the CBI as green. And this includes finance leases, commercial paper, bank debt, as well as bonds in the USPP and the market here. So these are the only two issuances so far in New Zealand, but if you have a look at where the rest of the world has gone and how Australia has moved over the last couple of years, I really see huge opportunity here, and I really believe that the market in New Zealand is on the verge of taking off. Which brings me to my final slide. If it sounds interesting to you as a way of raising debt and awareness for your business, how can you prepare for this? And Andrew's going to love me saying this, but getting Neighbours NZ ratings is a really great way to get started because if you have that data, and even better if you share it and you make that data available to the market, that really does help to build better understanding about what qualifies as a green building here and better transparency around defending your choices around thresholds. I think it's interesting to note that in Australia it's compulsory actually if your building's over 1,000 square metres, then you have to obtain a rating and you also have to publish it when you lease or sell your building. That doesn't yet exist here in New Zealand, but I do think that that particular policy has led to a really high amount of stock of highly rated buildings in Australia, and the converse is the challenge here in New Zealand. But I do hope that's sort of all I wanted to say. I hope that's been interesting and useful and helped to explain a little bit about what green bonds are and how they might be usable to you. And let me know if you have any questions.